And welcome everyone to another Smart Money Circle show. I'm Adam Sarhan. With me today is Salvatore Capizzi, who's the Executive Vice President at Dunham Associates Investment Counsel, Inc., with over $5 billion in AUA and AUM. Sal, thank you so much for taking the time, and welcome to the Smart Money Circle.
It's my pleasure, Adam. Thank you for having me.
So Sal, I always like to begin the show. Can you tell us a little about yourself and how you got to where you are today, please?
Certainly. So I have been in the asset management business for, I guess now it is approaching, well, about 30 years.
Nice.
So I started as a financial advisor. I wound up going to what was then Shearson Lehman Brothers, ultimately became Shearson Lehman Hutton, as the sales manager for their mutual funds, cup of coffee between there. But then I started the mutual funds for BlackRock.
Oh, wow.
So back in '94, when BlackRock started the mutual funds, I was recruited over to them. I had already known some of the principals, Larry Fink, and so on from Shearson, and I was brought over to start those funds. And I was there for about 8 years. I wound up leaving. I was the CEO for wealth management for a European company, and then I have been with Dunham now. I'm in my 17th year here at this firm.
Oh, I love it. So that's a perfect segue. Can you tell us a little about Dunham and what you do, please?
Yes. So to understand Dunham, you have to understand Jeffrey Dunham. Jeffrey Dunham is the founder of Dunham and Associates, and he was an RIA. He wasn't necessarily a portfolio manager. He had a vision. His vision was that if he could create a model where the SMA managers that he hired for his clients, or in other words, to manage the assets, if they got paid based on their ability to outperform their benchmark, in other words, to be accountable to that benchmark, and if he got paid as a financial advisor only when the client made money, he would have a model that can develop trust. And if he did, he would be able to work with ultra high net worth clients, right? So he made this suggestion to the firm that he was working with. They thought it was a noble concept, but naive, that it couldn't work. So in 1985, at the age of 23, wow, Jeffrey started Dunham. And exactly with that vision. So the portfolio managers that he hired got paid based on their ability to outperform their benchmark, and he got paid when clients made money. The model worked. So eventually he had enough financial advisors saying, boy, I'd love this model, that he decided to wholesale the concept. Right. So we started working within the broker-dealer community. So today we are one of the only funds that I'm aware of where all of the institutional managers are paid based on their ability to outperform the benchmark. They make more if they outperform. They give up a substantial portion of their fees, one down to zero if they underperform. And then for financial advisors, it's the option that some of the firms have, where they could either have a performance-based fee or they could have the traditional flat fee.
I love that. So let's talk about that a little bit. If I'm a financial advisor, I come to Dunham, what exactly do I get? What are the services you offer, so on and so forth, please?
So what you get, we are a third-party asset manager. So basically, we will do the manager selection. We will do the manager monitoring. We'll do the asset allocation. Right. But we work with a financial advisor. Some financial advisors like to use our managers, but want to do their own allocation. So we keep it as flexible as possible. Another important part of Dunham is Dunham Trust Company. It's an affiliate that we have. Through Dunham Trust Company, we're able to provide the financial advisor with trust services. And our model is that we bifurcate the trust administration with the investment management. In other words, the investment advisor, the financial advisor, is the one that manages those assets. We don't compete with them for those assets.
Okay, I love that. So you have a trust business, which helps on one side of it, and then you have the portfolio, the third-party money management on the other side of it. That makes perfect sense. How about your investment strategy? Can you speak to that a little bit, please?
Yeah, so Adam, we are a strategic asset manager. So what we do is we make allocation changes on a quarterly basis, but we creep into those changes. We don't leap into it. So you will not see Dunham with suddenly one quarter we go from 10% in emerging markets to 40% in emerging markets. What we do is we try to spot a trend. We try to understand where the markets are going and start slowly going into that trend over the various quarters. But the most important thing that I believe we have is our investment overlay, what we call Dunham DC.
Okay.
What Dunham DC is, it's an overlay. It was inspired by Warren Buffett. Warren Buffett said, you know, be fearful when others are greedy and be greedy when others are fearful. What this overlay does, it will take a look at purchasing the more equities when markets are going higher and many times trading at higher multiples, sometimes cannot be sustained.
Right.
And then as the market's pulling back, then at that point we'll be buying equities as there may be, people panicking to sell equities, sometimes below its intrinsic value.
Okay, that makes perfect sense. And how about risk, Sal? How do you handle risk, and what are some mistakes you see people make with respect to risk management?
So we have four areas that we use in terms of risk. Obviously, diversification and quarterly rebalancing are measures that are or strategies we use in terms of managing risk. But we are also very much, and have been for a long time, we're very much into alternative investments and the use of alternative investments, both on the fixed income side and also on the equity side, in order to manage some of that risk. And then in addition to that, we have that Dunham DC, the strategy where what we're doing is we're selling as markets going higher, buying as markets are going lower. And Adam, that strategy, it's a simple strategy. It's math. It's simply looking at the price of the market. So this isn't about 42 factors that are being thrown into an AI to try to generate, times to buy and sell. It's simply taking a look at how much the market has gone up or how much the market has declined to make those determinations in terms of the buying and selling.
I like that. So that makes sense. And then what are some mistakes you see people make with in markets and allocation, investing, anywhere you want to go with that question? And how do you avoid them?
I see way too many financial advisors chasing alternative investments. Gold is doing well. Now that it's hitting new highs, now they're adding it to portfolios, right? And every investment tends to move in cycles, right? So you have commodity funds and they're doing extremely well. And the financial advisors going into the commodity fund after it's been up, much higher. And as such, many times we hear financial advisors saying, I've tried to use alternatives and they simply do not work, right? But the other thing is, and I think it was a statistician, George Box, who said that all models are wrong, right? But some are useful, right?
Right.
What he's basically saying is, when we're creating our model, right, when we're creating our investment, what we're doing is we are making guesses, right? We're guessing at the direction of the market. We're guessing at the direction of certain things like interest rates or inflation. And what you need to do is you need to revisit it. You need to be making sure that you're taking a look at those models on a consistent basis. I know the concept of buy and hold is a popular concept, and it works. So please, I'm not disparaging the concept of buy and hold, but to me, that concept of buy and hold, just buy it, hold it, don't look at it, go back, watch it 10 years later, you'll be happy with what you see. Those type of arguments, that is fine for trying to manage clients who utilize what we call here at Dunham emotional market timing. In other words, where they get way too emotional about the markets and the headlines of the day, right? What a financial advisor needs to do is revisit the strategies that they're using. Take a look at where the markets are headed. Make a new guess in terms of inflation or interest rates or whatever it is that they're seeing, and make small adjustments along the way.
I love that. And how about timeless lessons you've learned along the way? You've been in the business for decades now.
So the biggest, Adam, the biggest lesson I learned is keep it simple. When I started, I became amazed at these various tools that there were in the market. I was always, investing as a young man, but boy, when I started learning about options and stop losses and the ability to combine these things, it got so bad, Adam, that I think I lost sight of what the client was trying to achieve. Because it became so complicated. It's trying to create these strategies that would work in virtually any market. So the net result was that basically I started just whipsawing myself, right? I learned quickly stop losses are wonderful strategies, but you have to understand how to use them, right? There's a large percentage. I don't remember exactly what that percentage is. I believe the percentage is almost 70% of the time that when the market goes into correction territory, it bounces back up to a new high. So you have a stop loss, and I was all happy because the market's going down. I stopped out, at a 10% loss, only to see the market start pulling back. And now I have to make a decision.
Right.
When do I go back in?
Right.
Anytime you start working those type of strategies, you have to be right twice.
Yeah.
You have to be right when you're coming out, and you have to be right when you go back in. So Adam, the lesson is keep it simple. Don't overthink investment strategies.
I love it. And then Sal, you talked about DC a little bit when your strategy. I know you do a lot of retirement work as well. Can you speak to that a little bit, please?
Yeah, so what we do at Dunham, we work with a lot of retirees, obviously, because the demographics are just there, right? Yeah. But we also work with a lot of trusts where the matriarch and the patriarch have passed away, and now the financial advisor is managing money for the children, and the children are receiving income from these trusts.
Okay.
Right. So that's the reason that the Dunham DC, right, that strategy that was inspired by Warren Buffett and the concepts of investing, when others are fleeing the market and selling at the higher, potentially higher prices. The reason for that is sequence risk. Okay. To me, when you take a look at risks of that clients have, a financial advisor can put together, Adam, the most perfect portfolio that you can imagine. A portfolio that has everything that it should have. The financial advisor did nothing wrong other than the fact that when the portfolio or the client went into those investments, the market turned, right? And the client experienced poor results early on, right? So that's where sequence risk basically will hurt those beneficiaries, those children receiving income from that trust, or the retiree that just retired and now is drawing income as the market's coming down lower. Right, so that is the primary thing that we see, and that's a risk that we at Dunham really took a hard look at to try to determine how do we help a financial advisor through that. And we believe that through Dunham DC and that overlay strategy, and Adam, it's only an overlay strategy. This is not a separate type of account that we have. It's simply over our regular asset allocation program. It just is a thermostat that adjusts the amount of equity or fixed income will be within that portfolio.
I love it. Well, Sal, thank you so much for taking the time to speak today. What is the best way for people to get in touch with you or learn more about Dunham?
Well, there are two ways. You could obviously visit our website at www.dunham.com, or you can call our business development team, and they can be reached at 858-964-0500.
Beautiful. Well, Sal, thank you so much, and hopefully we'll have you on again soon. This was great.
Right. It's a pleasure. Thank you.